Hi YouTube and welcome back to the channel Retail Investing and Trading. In today's video we will go over correct and exact rules for the bad pattern. But before we go there and before I show you the correct rules so that you can trade this highly profitable harmonic pattern, please click that subscribe button below, click that like button and smash that bell button so that you can help YouTube algorithm to rank our videos and that we can help as many people as possible. So stay tuned until we get back. And we are back. Thank you very much for watching that new intro of ours and I hope you like it. And so without further ado, let's go straight into content, into the rules for the bad pattern. And why am I recording this? Why am I recording this video and why am I teaching you the rules of engagement for the bad pattern? Because I've seen a lot of people on the internet claiming to teach the bad pattern, however, very few of them actually do. They teach something that's similar to the bad pattern, but they don't have a strict rules. And as for everything in trading, you gotta have a strict rules that you have to follow, and only when those rules are met in the market, you should trade. You would be allowed to trade only if those rules are met. So with that being said, the correct rules for the bad pattern are just in front of you. So at first we gotta identify the X point and the impulse leg, okay? And then we have, in order for the AB leg to be valid, the price at B point at least needs to touch the 50% retracement, etc., etc. But the point of this video is not for me to read through the rules and then click the stop button. It's actually to show you this on real life examples. So let's hit the charts and then I'll show you, okay? Okay, so right now we will take this, we have this dark chart here because I want to go through a raw example to cover the rules that you can see at the bottom left corner in the video. You can see the rules, those are the same rules that we had on full screen right before. And now we will go through rules and then I will explain you on a blank chart, and then we will go on a chart and find a few examples of a bad pattern, okay? So first, what rule says is identify the X point. So we will assume that this is our X point right there. Maybe I can just include the caps lock. Let's see, can I do this? Yes, it's a little bit bigger. And then that our move is like this. And this here, this price here would be our A, X to A leg, X point, A point, okay? So let's say that this is our A point. After we have this impulse leg, okay, then we need to have some kind of the retracement. Well, that retracement is actually called AC leg, AB leg, okay? So, and it has its own rules. Basically, the rules for the B price point is very simple. In order for AB leg to be valid, I'm gonna draw the line. Let's assume this is a B leg. Okay, let's add this B letter. In order for B leg to be valid, we need to have what? The price at B point needs at least to touch the 50% retracement from X to A. Okay, 50% fib retracement, but should not touch the 61.8 retracement. So what do? We take our fibs out, we draw fibs from X to A, okay, and we see that this B price point needs to be anywhere here but should not touch the 61. If it touches the 61 retracement from X to A, this pattern is gonna be invalid. Okay, I'm gonna change the color so for you will be easier to see. Okay, if this B price point touches the 61, we no longer have the bad pattern. We might have something else, but in this video we are covering the bad. So for this example, let's say that it touched the 50%, but it didn't touch the 60. Okay, so we have a valid B leg. Now we can remove fibs because we have our X to A to B, and people are drawing our the patterns like this. We will mark this in green color and put it, let's, yeah, fill triangle with area with color, but we'll add some opacity, reduce it. Okay, so we have X to A to B. Now we need to find our B to C leg or our C point. And the definition for the C point is this. The price at C point, give me a second, here, which would be somewhere here, the price at C point at least needs to touch the 38.2 retracement from A to B, but not violate the A point. And by violation, I mean even if the slightest wick goes just a point, not even a pip, half of a pip above the A point, we no longer have a valid pattern, not at least the bad pattern, okay? So what do we got to do? We take our fibs out, we drag them from A to B here, and we check where our C point needs to be. So from B, we need this in blue. We need this in blue. Okay, here we go. So it says that it needs to touch the 38 and can be in any range from 38 to 100% retracement from A to B. But if it goes above the A point, the pattern is invalid. Okay, so for this example, we will put it here. Okay, and now we have our C leg. So let's put C. This is colors. We have our blue color. Okay, there we go. We have our C leg and we have our B to C leg and our C point. Now we have to find, when you identify this kind of a pattern, now we need to be on the alert that the bad pattern can happen, because if the price moves down from this price point somewhere around here, we will get to the D completion point, D price point, which is also called, a lot of people are calling D completion point, and then you gotta think, will you engage or not? And there are some rules of entering the pattern, which can be pending orders, or you can wait for a higher close, or whatever you back tested. But here I'm just covering the rules. What is the price point for the entry? Okay, so let's assume that this price point, that the price is moving lower, and it needs to come to the price point which is equal to Fibonacci retracement of 88.6 from X to A. Okay, so let's find this. Okay, we will remove everything else. So the price needs to move all the way to this point here, and when it moves, you should put your pending orders, if you were to trade it with a pending orders here. Okay, so there is no more violation. Even if the price moves down here, the pattern is still valid because it triggered. You should already be triggered in if you're trading with pending orders. Okay, so the decompletion, the price point where you should enter the trade, if is at 88.6 Fibonacci retracement from X to A. So let's draw this triangle. We will change the color later. Okay, into green we set. Let's put this. Isn't? Okay, good enough. Okay, so now we have our bad pattern, which gives us our D point. Let's change the color to blue. Okay, so X to A to B, B to C, and C to the D completion. So this is how bad pattern actually looks like. And then we need to set our targets, which are, as we have on rules, Target 1 should be at 38.2 retracement from A to D, which means you take our A point and you drag it all the way down to the D point, okay? So we need our 38. We don't need any of this. We need 61 and 38, okay? And now the target 1, we will take is this here. Sorry, is this here. Uh, and target 2 is then 61.8 retracement, which comes here. Okay. And the risk, guys, is somewhere below this X point, but the rules for risks are, whatever you backtested. I'm not gonna cover the risk or stop loss because whatever you backtested will probably work. And just you need to go through historically through markets, find these patterns and see what kind of risk settings can this works for you. Okay, because sometimes people use ATR based stop below the X point. Some people use some kind of fib inversions from A to X. Some people use a bunch of different things. Okay, equal, fixed amount of pips below the X point, etc., etc. Some people need 1-to-1, so if they see that from D completion to 38 is 15 pips, they will put 15 pips here, so they will reduce the risk, etc., etc. The thing here is that rules for engagements and for each and every leg are in front of you. Those are the rules for the bad pattern. Okay. Now, when you see in rules that price that the targets 1 and target 2 can move in case that price moves against you, this is what I mean. So I told you that I'm gonna just slightly move on the side fibs. That the decompletion point can move down, right? Because this is live price. Price moves down, moves down, and then it triggers you in a trade. But a candle in many cases, like in 99%, 99.9 cases, percent of cases, the price will not immediately reverse and hit your targets. No, price will probably move a little bit down and a little bit down, a little bit down, and then can reverse from this price point. Yes, and then maybe you get a different risk to reward ratio because the price came down and then it goes all the way up. Okay, and now your decision can be that you stick with the initial 38.2 retracement from initial A to D point, and for targets to on the original 61.8 fib retracement from initial A to D. But some people tend to trail their uh, targets, not stop losses, but targets. Okay, not increasing the risk, but rather trail target. So what would that mean? Is basically as the price moves down, you just moved your fib level down, and you can see how 38.2 retracement and 61 is also being moved down. Okay, so in this case, let's say that the price came to this price point and then reversed and came to this here. So it came here, reversed, and came here. It actually didn't hit our initial 61.8, but in case that you were trailing your target 1 and target 2, then you would got hit both targets, because then your targets 1 would be this. Wait. See? So you would got hit both targets. And in the first case, if you weren't to trail target 1 and target 2, you would still be a few pips away from target 2, but your target 1 would be hit. That, of course, has its own cons and pros. Pros would be higher win rate, and cons would be reduced risk reward because we didn't change risk, but the targets have changed. Now, with that being said, in case you have any questions, I gotta invite you, please, you know, comment below, ask those questions, and I'll try to answer them as soon as possible and try to help you as much as I can. And with that being said, also smash that like button, click that subscribe button, and smash that bell button so that we can help almighty YouTube algorithm to rank our videos. Okay. Now, as I promised, let's go to the charts, to a really real life chart, and let's see this bad pattern in live action. Here we are. Okay, so in front of me, I have the euro dollar chart, and I'm watching the time period of 26th of September 2018. I found this period before because those patterns depends on your eyes, but you get around 12 to 16 of them on 1 hour time frame, or maybe 12 to 20. Depends what you see, what you find valid, what you skip, which is completely discretionary. And some people might find this pattern that I have here, like this, not valid for them. However, it is valid for me because I went through a bunch of these markets manually, candle by candle, and uh, I take in consideration this kind of X point, this kind of A points, etc., etc. So it's a valid bad pattern for me. With that being said, let's go through our rules of engagement and let's draw this bad pattern here. Okay, so taking a trend line, this is our X point, this is our A point. The colors are playing with me again. I'm gonna use the white, and that's gonna be good enough. Okay, so X to A point, yes, this is it. And now we are looking for our B point, which needs to be at 50% retracement from X to A. I forgot to put X. Again, colors, colors, colors. X to A, and then we have A point. X to A point, it needs to be 50%, but not over 61. It actually should not touch the 61.8 retracement. So we go from here to the highest point, which is okay. So it's not touching the 61, but let's just confirm that it touches 50, which it obviously does. So we have our X to A to B point right there. Okay, so I'm gonna remove my fibs. I'm gonna mark it down with the triangle. Okay, so we have X to A to B point here, and we're gonna mark it as a green one, and gonna add transparency for everybody to see. And this is our B point. Okay. Okay, now we are looking for our C point, which is actually B to C leg. And rules for the C point are: we need to have the Fibonacci retracement from A to B. It needs to at least touch the 38.2, but should not violate the A point. Okay, which is true. It touches 50 and it's far away. It's 17 pips away from the A point. Okay, and now when we have this, we have our valid C point. C point. Now we are looking for the D point. Okay, let's imagine that the price is live and that it started moving down. We have this shooting star, we have a lower low, lower close, and we have a bearish engulfing. Now we are looking at the fib retracement from X to A, 88.6, right? So let's see, where is our 88.6. It's here, and price is moving. We are here. Price is moving towards our 88.6, which is this point right there. So I'm gonna use the triangle again. Triangle, this is the 88.6. I'm gonna change the color again. Let's put it in this. Let's get it. And we are activated. Okay, so we have X to A to B, B to C, and now we are at our D completion point. We are activated in a trade, and what happens? As I said in the example, price moved against us once, then it moved against us a little bit more, and then it returned turned around and hit our targets. I see that it hit our targets, but let's mark our targets as well. Our targets are here. So in this case, if you didn't move your targets, in case that you were trading these live, your target one would get hit in what, 1, 2, 3, 4 hours, roughly 4 hours, depends on the spread. And your target two would get hit here. Okay, so at 6 p.m. 26th of September, depends on the time zone you're in. But in case that you were moving your targets, okay, because the price moves against you, up, your target one would get hit 1, 2, 3 hours from your entry, and your target two would get hit right here. You wouldn't need this news candle, and I can see this is a news candle because it's, huge spike up, huge spike down. It's obviously some kind of a battle uh, between bears and bulls, and it actually signifies indecision because they didn't move market neither up or down. When the candle closed, it kind of stayed where the candle before was, a few pips difference. Yeah. So basically that's it. We have a target one hit here if you're moving targets. Target two got hit here if you're moving targets. If you're not moving targets, your target two would get hit only on this news candle, and target one would be hit probably at the same time, or depends on the spread, or 2 hours later. But moving targets or not should not be, based on how long will based on the decision how long will you be in a trade. It should rather be based on your backtesting results and depending on how it increases or lowers your expectancy and your, how much profitable will you be. In this case, even if we put a stop loss 5 pips below our X point, we would still be in a trade because the lowest wick was here, which is actually 4 pips below the X point. But as I said, ATR on the entry candle was, let's see, ATR is average to range is 12 pips. So if you were to put 12 pips below here, your risk, you would actually end up being here, which is far away, which is 8 pips away from your, most, the candle that bears, where the bears push the most towards your stop loss. Okay. Well, with that being said, hopefully this makes sense for you. Hopefully you will start backtesting this and implementing in your trading plan, in your trading situation. And yeah, that's it. One more time, click that like button if you find this video helpful. Also, click that subscribe button and smash that bell button. Thank you very much and see you soon. Bye bye.